Welcome back to Report of Silver. If you are serious about protecting your wealth through gold and silver, then today's market action is something you need to understand very carefully. Because what happened in silver today was not just another normal pullback. This was not simply a routine correction or a quiet day of profit-taking. Silver was hit hard, dropping nearly $6 from the session high to the session low. And for many investors and silver stackers, that kind of move can feel shocking. It can feel frustrating. It can even create doubt. But as your silver analyst, my job is to help you separate emotion from reality and explain what is really happening beneath the surface. Today we are going to break down exactly why silver fell so aggressively, what hidden forces are driving this move, and most importantly, what this could mean for the weeks and months ahead. So before we begin, I want to hear from you.
Did you buy this dip, or are you waiting for an even lower price? Drop your thoughts in the comments below, and if you value honest silver market analysis, please like this video, subscribe to the channel, and join our growing community of serious stackers. Now let's begin with the obvious headline. Silver was crushed today. At one point during the trading session, silver dropped all the way down near $73.30 per ounce. That is a major move in a single day, especially when just recently silver was threatening to push above $80 per ounce. At the time of this recording, silver has recovered somewhat, trading near $74, but it is still down nearly 5% on the day. That is a massive move by any standard. Gold also declined, though not as severely, dropping about $80 and sitting near $4,487 per ounce. Gold and silver both suffered, but silver once again reminded everyone why it is called the most volatile precious metal. Now many people immediately ask the same question whenever silver falls like this. Is the bull market over? Has the rally ended? Is this the beginning of a bigger crash? My answer is simple, not necessarily. In fact, what happened today tells us more about short-term pressure than long-term weakness, and that distinction matters. If you are a trader, today probably felt painful. But if you are a long-term silver stacker, today may actually be presenting opportunity. The first major factor behind today's decline came from economic data in the United States. Specifically, pending home sales rose by 1.4% in April. That may not sound dramatic, but markets pay attention to these signals. Economists expected only a 1% increase, so this stronger than expected number sent an important message. It suggested that the housing market is more resilient than expected. It suggested that the broader U.S. economy may not be slowing as quickly as some believed. And when markets interpret economic strength, they begin adjusting expectations for interest rates. That is where precious metals run into trouble. Gold and silver generally perform best when interest rates are falling or expected to fall. Lower rates reduce the opportunity cost of holding metals because silver and gold do not pay interest or dividends. But when strong economic data appears, investors start thinking the Federal Reserve may delay rate cuts, or worse, consider raising rates again. That is exactly what happened today. Suddenly, traders began pricing in a higher chance of a rate increase by the end of the year. That pushed bond yields higher, strengthened the US dollar, and immediately put pressure on gold and silver. This is an important lesson for every silver investor. Sometimes silver falls, not because anything changed in silver itself, but because broader macroeconomic forces temporarily overwhelm the metal. That is what we saw today. It was not a collapse in industrial demand. It was not a breakdown in physical demand. It was not a structural failure. It was markets reacting aggressively to changing expectations about monetary policy. But that is only half the story because there is another layer here, and this is where things become more interesting. Oil prices remain elevated because of continued tensions involving Iran and the broader Middle East. Even though oil pulled back slightly, it is still holding above $100 per barrel, and that matters. Higher oil prices feed inflation. Higher inflation makes central bankers nervous, and nervous central bankers tend to keep rates higher for longer. That becomes another indirect pressure point on silver. So what we are seeing right now is a tug of war. On one side, silver's long-term fundamentals remain strong. Industrial demand is high. Physical demand remains solid. Structural deficits still exist. But on the other side, short-term macro pressures, interest rates, inflation fears, stronger economic data, and geopolitical uncertainty are creating heavy volatility. That is why silver can fall sharply, even while its long-term story remains intact. And that is exactly why today's move should not be viewed only as a price drop. It should be viewed as a test, especially for silver stackers. The question is not whether silver can be volatile. We already know it can. The real question is whether your conviction is strong enough to handle that volatility. That is what separates casual investors from committed stackers. Today was not just a market event. It was a test of discipline. As we move deeper into this market analysis here on Report of Silver, we need to talk about the second major force pressuring silver right now. And in my view, this is something that many investors are not paying enough attention to. It is easy to focus only on today's price drop and assume this is all about the Federal Reserve, interest rates, and stronger than expected housing data. Those are certainly part of the story, but they are not the entire story. There is another major player influencing silver right now, and that player is India. What happens in India matters tremendously to the silver market, and I believe it is becoming one of the biggest short-term risks that silver investors need to watch very closely. Now, when people think about India and precious metals, most immediately think about gold. That is understandable because India has one of the strongest cultural connections to gold anywhere in the world. But what many investors forget is that India is also one of the largest consumers and importers of silver in the world. In some years, India has imported hundreds of millions of ounces of silver. That makes it one of the most important demand centers in the global silver market. When India changes its buying behavior, the global silver market feels it almost immediately. What appears to be happening right now is that India is introducing tighter controls and restrictions related to silver imports. These policy moves may seem technical on the surface, but their impact can be significant. If India slows silver imports, even temporarily, global demand appears weaker in the short term. Markets react quickly to that kind of signal. Traders do not wait to see the long-term outcome. They react immediately, often by selling first and asking questions later. That contributes to downward price pressure. This helps explain why silver started weakening even before the major sell-off accelerated today. There were already signs of pressure building beneath the surface. Once silver fell below key technical levels, especially below $76 per ounce, momentum traders stepped in and pushed prices lower even faster. That is how modern markets work. A fundamental concern starts the move, technical traders amplify it, and suddenly what begins as a modest decline becomes a sharp sell-off. But here is where we need to be very careful not to overreact. India's actions may absolutely create short-term demand weakness. That is real. It could interrupt silver's momentum. It could create more downside volatility in the near term. We may see silver remain under pressure for days or even weeks if these restrictions continue to dominate market sentiment. That is possible. But temporary demand disruption is not the same as structural demand destruction. Those are two very different things. Silver still faces a structural supply deficit. That has not disappeared. Global mine production has not suddenly increased dramatically. Industrial demand from solar panels, electronics, electric vehicles, and other sectors remains strong. Central bank policies globally are still creating long-term monetary uncertainty. None of those long-term bullish factors changed today. What changed today was market emotion and short-term positioning. This is why experienced silver investors understand something very important. Volatility creates confusion, and confusion creates opportunity. New investors often see a sharp drop and immediately panic. They assume something must be fundamentally wrong. They start questioning their entire investment thesis. But seasoned silver stackers often see the same event very differently. They ask a different question. Has the long-term story changed? If the answer is no, then lower prices may simply represent better value. That does not mean every dip must be bought immediately. Timing always matters. Risk management matters. Cash management matters. But emotionally, this is where discipline becomes essential. Silver has always been a volatile market. It has never rewarded weak hands. It rewards patience. It rewards conviction. It rewards people who understand why they own it. And let us be honest, silver's volatility can be brutal. A 5% move in a single day is enough to shake anyone's confidence. You look at your holdings, and suddenly your portfolio value is lower than it was yesterday. That feels painful. It is easy to become discouraged. But remember this, the silver in your hand has not changed. Your physical ounce is still your physical ounce. It did not become less silver because a futures market somewhere decided to market lower today. That is one of the great psychological advantages of physical silver ownership. If you are holding coins, bars, or rounds in your stack, the intrinsic value remains. The market price changes every second, but the metal itself remains constant. That perspective helps investors stay calm when paper markets become chaotic. So right now, India is adding another layer of pressure to an already fragile silver market. Higher rates are a headwind. Elevated oil prices are a headwind. Middle East tensions are a headwind. And now India's policy changes are another short-term challenge. When multiple pressures hit at once, markets can react violently, and that is exactly what we saw today. But do not confuse short-term pressure with long-term failure. That would be a mistake. In fact, these moments often separate emotional investors from disciplined ones. Silver is testing people again. It does that often. The question is not whether silver is volatile. The question is whether you are prepared for what silver does best. Move aggressively in both directions. Now, as we continue this breakdown here on Report of Silver, we need to address what may be the biggest emotional challenge facing silver investors right now, and that is volatility. Everyone loves silver when it is moving higher. Everyone feels confident when silver is pushing toward new highs and headlines are celebrating the rally. It feels exciting. It feels validating. It feels like all the patience has finally paid off. But then days like today happen. A sharp sell-off appears almost out of nowhere. Several dollars disappear from the price in just a few hours, and suddenly the emotional tone changes completely. Optimism turns into anxiety. Confidence turns into doubt. That is exactly why understanding volatility is absolutely essential if you are serious about stacking silver. Silver has always been a volatile asset. In fact, that volatility is part of its identity. This is not new. Silver moves more aggressively than gold, both up and down, because it is a much smaller market. It takes less money to move silver than it takes to move gold. That creates larger price swings. When buyers rush in, silver often outperforms gold dramatically. But when sellers rush out, silver usually falls harder too. That is simply the nature of this market. What we are seeing now is a continuation of that pattern. Over the last several months, silver has been trading in a wide range, roughly between $70 and $80 per ounce. That is a very large range, but importantly, we are still inside it. That means despite today's dramatic sell-off, the broader trading structure has not been broken. Silver has not collapsed out of its range. It has simply moved from the upper edge back toward the lower portion of that same range. Technically, that is not unusual. Emotionally, it feels much bigger than it actually is. That is one of the traps investors fall into. They confuse emotional impact with structural impact. A big daily drop feels catastrophic, but that does not mean the long-term chart has been destroyed. In fact, today's move may look much less dramatic 6 months from now than it feels today. Markets often create emotional noise in the short term. That noise can distract people from the bigger picture, and the bigger picture still matters. Silver remains in a long-term environment where demand continues to grow. Industrial usage remains strong. Solar demand is expanding. Electrification continues worldwide. Investment demand remains elevated. Physical shortages have not disappeared. Supply growth remains constrained. Those are the long-term realities that support silver. One difficult day does not erase them. Now, that does not mean the road ahead will be smooth. In fact, I think investors need to prepare mentally for more turbulence. We could absolutely see more weakness. If geopolitical tensions cool temporarily, if oil prices stabilize, and if central banks continue sounding hawkish, silver could face additional downside pressure. It would not surprise me at all to see another test of the lower end of this range. That is possible. It may even happen quickly. At the same time, this market can reverse just as fast. That is what makes silver so unique and so difficult for many people to handle. One major headline out of Iran, one surprise inflation report, one unexpected central bank decision, or one shift in industrial demand expectations could reverse sentiment overnight. We could go from panic selling to aggressive buying in a matter of hours. That is why trying to predict every short-term move in silver is almost impossible. That is also why many experienced stackers follow a different strategy. Instead of trying to perfectly time every move, they focus on accumulating consistently. They use weakness to add to positions gradually. They understand that over time, their goal is not to beat every daily price movement. Their goal is to own real metal and build long-term wealth preservation. That mindset changes everything. Instead of seeing volatility as an enemy, you begin to see it as part of the opportunity. Lower prices can mean better entry points. Discounts can create value. Premium compression can improve buying conditions. That does not eliminate risk, but it changes how you respond emotionally. And let me say something very clearly here. If you are holding physical silver, your investment thesis should not be built around daily price action. It should be built around why you own silver in the first place. Do you own it as insurance? Do you own it as protection against currency debasement? Do you own it because you believe in the long-term supply-demand imbalance? If those reasons are still valid, then temporary price swings should not shake your conviction. That is what separates true silver stackers from short-term speculators. Speculators react emotionally to every move. Stackers focus on the long-term mission. They understand that silver has survived wars, recessions, inflation cycles, currency resets, and financial crises. It has held value for thousands of years. Today's price chart does not change that history. So yes, today was painful. No one enjoys seeing silver down nearly 5% in one session. But pain and opportunity often arrive together in this market. The question is whether you are looking at today through the lens of fear or through the lens of long-term strategy. That answer will determine how you handle the next move silver makes. As we move into the fourth part of today's market report here on Report of Silver, I want to shift our focus away from the paper market for a moment and back towards something that many silver investors often forget during days like this, the physical market. Because while traders on screens are reacting emotionally to price movements, physical silver continues to behave very differently. And this is one of the most important distinctions any silver investor can understand. The paper price may be falling, but that does not always mean the physical opportunity is disappearing. In many cases, it means the exact opposite. This is where disciplined stackers begin looking for opportunity. When silver drops sharply, especially in a fast and emotional sell-off, many people freeze. They hesitate. They worry that prices may go lower tomorrow, so they wait. And sometimes that is a smart move. But very often, local coin shops, online dealers, and bullion sellers begin adjusting inventory in ways that create tremendous opportunities for physical buyers. This is where understanding the difference between spot price and real-world buying opportunity becomes incredibly important. Today is a perfect example of that. While silver was falling aggressively on the screen, there were physical opportunities opening up in local markets. I personally took advantage of one of those opportunities at a local coin shop. I found brilliant uncirculated winged Liberty dimes, beautiful historic silver coins, selling below spot price. Think about that for a moment. During a day when many investors were panicking, there were physical silver products available at prices that represented real value, not just in bullion terms, but almost in numismatic terms as well. That is why experienced stackers always say you need to know your local market. Not all silver is priced the same. Not all dealers react the same way. Some local shops move quickly. Some hold inventory longer. Some aggressively lower prices to move product. Others keep premiums high. If you know your dealers, if you understand your local market, and if you stay alert during volatile periods, opportunities can appear that are simply not visible on a price chart. And this brings us to another important lesson. Not all silver is created equal. That may sound obvious, but it matters. A generic 1-ounce round is different from a government-issued coin. A historic 90% silver coin is different from a newly minted bullion bar. A numismatic piece carries different value dynamics than a standard bullion product. Smart stackers understand those distinctions. They do not just buy silver, they buy value. That is especially important during volatile periods because premiums behave differently depending on the product. Sometimes generic rounds see premiums fall quickly. Sometimes government coins hold stronger premiums because demand stays elevated. Sometimes junk silver becomes the best bargain. Sometimes larger bars offer the best ounce-for-ounce value. Every correction creates a different opportunity set, and that is why paying attention matters. Another reality many investors overlook is what happens at the refinery level. When scrap silver enters the market, it does not instantly become a polished bullion product. It must be processed, refined, and redistributed. That takes time. That ties up capital. It creates bottlenecks. During volatile markets, those bottlenecks can create strange pricing behavior. Dealers may acquire silver cheaply from sellers and then pass some of those savings along to buyers because they need inventory turnover. That creates windows of opportunity that can disappear quickly. This is why I often tell stackers to think like business owners, not just buyers. Dealers must remain agile. Coin shops must adapt daily. Online dealers constantly change pricing and inventory strategy. If you understand that dynamic, you can position yourself better. Instead of reacting emotionally to headlines, you begin watching dealer behavior, premium shifts, and local availability. That gives you an edge. Now let me be very clear. I am not saying everyone should rush out and buy every dip. That would not be responsible advice. Everyone has different financial circumstances. Cash flow matters. Emergency savings matter. Debt matters. Personal risk tolerance matters. But if you are already committed to stacking silver and you have dry powder available, these kinds of market moments are often when value appears. And perhaps most importantly, physical silver ownership changes your mindset. When you hold silver in your hand, whether it is a bar, a round, or a historical coin, you experience the market differently. You are less likely to panic because you are holding something tangible. You can see it. You can touch it. You understand it as real wealth, not just numbers on a screen. That psychological advantage is powerful. That is why many long-term stackers develop what I call diamond conviction. They understand short-term volatility. They respect it, but they do not let it control them. They hold tightly to their core stack because they know why they built it in the first place. The price can rise or fall, but their conviction remains steady. And today, more than ever, that mindset matters. The market is volatile. Headlines are changing fast. Emotions are running high, but physical silver remains exactly what it has always been. Real money, real value, and real wealth preservation. That has not changed, and that is a truth every serious silver investor should remember. As we close today's market report here on Report of Silver, I want to leave you with what I believe is the most important takeaway from everything we discussed today, and that is perspective. In markets like this, perspective becomes your greatest asset. Without it, every price move feels personal. Every sell-off feels like disaster. Every headline feels like an emergency, but with the right perspective, you begin to see what is really happening. You stop reacting emotionally and you start thinking strategically. That is how long-term wealth is built, and that is exactly how serious silver stackers survive and thrive in markets like this. Today, silver dropped hard. There is no way around that reality. A nearly $6 move from the session high to the session low is dramatic by any standard. It gets attention. It creates fear. It causes frustration, especially for newer investors who may not yet be used to silver's personality. But silver has always had this personality. It is aggressive. It is emotional. It moves faster than gold. It rewards patience, but it also tests patience. That is part of what makes silver both exciting and difficult. What happened today was the result of multiple forces colliding at once. Stronger than expected housing data, increased expectations that the Federal Reserve may keep interest rates higher for longer. Higher oil prices tied to ongoing Middle East tensions added inflation pressure. Rising inflation fears pushed markets toward more hawkish expectations. India's developing silver import restrictions created additional concerns about short-term demand weakness. Put all of that together, and you have the perfect environment for a sharp silver correction. But here is what did not change. The long-term supply deficit did not disappear today. Industrial demand did not collapse today. Solar panel manufacturers did not stop needing silver today. Electronics companies did not suddenly stop using silver today. The structural reasons many people own silver remain intact. That is critical to understand. If your reason for owning silver was based on those long-term fundamentals yesterday, then those reasons still exist today. That is why experienced stackers often view these corrections differently. They do not enjoy them, but they understand them. They know that volatility is part of the process. They know silver has never moved in a straight line. They know markets test conviction before rewarding patience. And perhaps most importantly, they know that physical silver sitting in their safe has not changed at all. 1 ounce is still 1 ounce. Its intrinsic nature remains exactly the same. That is a powerful truth in an increasingly unstable financial world. Currencies change, policies change, governments change, markets change. But physical silver remains silver. It has survived thousands of years of monetary evolution. It has survived empires, wars, inflationary cycles, recessions, and financial resets. That historical durability is part of why so many people continue stacking it, even during frustrating market moments. Now, does that mean silver cannot go lower from here? Of course not. It absolutely can. We may see more volatility in the days ahead. Iran headlines could move markets suddenly. Oil prices could swing sharply. Central bank expectations could change again. India's policy decisions could continue pressuring sentiment. There are still many moving parts. Investors need to be prepared for that reality. But being prepared does not mean being fearful. It means being disciplined. It means understanding your own strategy. If you are a trader, then manage your risk carefully. If you are an investor, then stay focused on fundamentals. If you are a stacker, remember why you began stacking in the first place. Was it wealth preservation, financial insurance, protection against inflation, portfolio diversification? Whatever your reason, let that guide your decisions, not daily market emotion. For many people, today may actually become one of those days they look back on positively, not because it felt good in the moment, but because it offered opportunity. Opportunity to buy lower. Opportunity to strengthen conviction. Opportunity to remind yourself that silver ownership is a long-term journey, not a short-term race. That is why I often say silver is not just an investment. It is a mindset. It teaches patience. It teaches discipline. It teaches emotional control. Those lessons matter far beyond markets. So my message to you tonight is simple. Do not let today's red candles define your outlook. Stay informed, stay calm, stay disciplined. Watch the fundamentals, watch the physical market, watch global developments. But above all, remember why you own silver. Let me know in the comments. Did today's dip shake your confidence? Or did it strengthen your conviction? Did you buy more, or are you waiting? I want to hear from you. If you found today's analysis valuable, please support Report of Silver by liking this video, sharing it with fellow stackers, and subscribing if you have not already. Thank you for spending your time with me today, and as always, keep stacking, keep learning, and keep your eyes on the bigger picture.